Your ability to identify liquidity can make or break your trades. It can be the difference between market doing the exact opposite of your analysis, taking you out and leading to a potential loss, or possibly leading you to break your monitor out of frustration. Or, on the other hand, you understand the magnet areas market is drawn towards, meaning you can take great trades with clear targets and you can avoid taking a lot of losses that you'd usually take without a proper understanding of liquidity. So in this video, I'm going to run you through 3 steps to liquidity which you need to understand. By the end of this video, you'll have a clear understanding of what is liquidity, what are the different types of liquidity, and how you can use liquidity to frame trades. Now, let's get into it. To start off, you need to understand what liquidity actually is. Now, liquidity in its simplest form is simply money in the market or orders in the market. Markets move based on the flow of order. If there's more buying than selling, market is going to move up. If there's more selling than buying, market is going to move down. Now, if you look at the chart, you guys can see the most significant points where market moves the most is after a liquidity sweep. As you guys can see right here, once we've swept these lows right here, you guys can see we do get a big move upwards. There's many scenarios of this, such as this intermediate time range right here. We sweep this high and you guys can see we do get a big move downwards. Whereas if you compare these moves to market moving mid-range, you guys can see they are not as volatile. They do not have as much energy. That's because there is barely or little to none traders that are buying or selling mid-range. Now, why does this happen? Now, just to bear in mind, retail traders, me and you, we make up 5% of traders. The other 95% is institutional traders. Now, these institutional traders, such as banks, hedge funds, etc., they have huge positions which they need to execute. However, trading is like any other financial market. In order to buy, you need to have sellers. In order to sell, you need to have buyers. Think about it like this. You want to buy a phone. Say you want to buy an iPhone. You cannot buy that iPhone if the Apple Store is not selling the iPhone. The same way the Apple Store can't sell that iPhone if there's no one willing to buy it. Now, how does this link back to trading? If an institutional trader, such as a hedge fund, a bank, if they want to place a buy order for $50 million, there needs to be $50 million worth of sell-side liquidity in the market. This is where liquidity comes into play. Institutions will instigate retail buying or selling in order to fund their positions. What do I mean by this? First, let's take a step back and let's think of in the minds of a retail trader, which is me and you. Whether you're trading ICT, smart money concepts, or simple trend lines, support and resistance, you are a retail trader and you are part of the liquidity pool. Let's take a look at our chart again. There are many opportunities to buy within this range right here. I'm going to outline a few. If you saw this order block right here, you'd think it's a fantastic idea to buy right here. Say you had your take profit, say at this high right here. And where would you place your stop loss? You'd place your stop loss right below the low right here. If you saw this fair value gap, where are you likely to place your stop loss? You are going to place your position right here. You want to place your stop loss below this low once again. Now, another example. If you are a retail trader, if you trade support and resistance and you see market forming this swing low, where are you likely to buy? You are likely to buy right here on this support. And you are going to place your stop loss below the low. You might place it below this low right here. And you'd place your top take profit somewhere up here. Now, with all these trades, you could have maybe become profitable from this one trade right here if you place your take profit somewhere here. However, these two traders will be used as liquidity. Both their stop losses would be triggered. The point is, many traders are placing their stop losses below lows. So once market comes and takes it out and it triggers their stop loss, what happens? Traders have to sell back their position. They have to sell their buy order at a worse price, meaning they take a loss on the market. Now, institutions can then use their losses, use them selling their positions back in order to place their buys. Now, as I said earlier, if you want to buy an asset, there has to be someone selling an asset. Now, many people's stop losses are being triggered. There is a lot of sell-side liquidity in the market. So institutions have a chance to buy here. This is why you get this a lot of volume in this move right here. This is why sometimes it can feel that markets are against you, because they are. Institutional traders are constantly looking to use you as liquidity. Now, what we want to do is we want to be on the other hand. We want to be not being used as liquidity. We want to trade with the liquidity. We want to catch these big impulses to the upside and downside. Now, in order to be on the good side of liquidity, you need to understand what liquidity is. Here, I've outlined what types of liquidity there are there, which is 3 main types. So to start off, this is going to be the main framework of your liquidity. Now, Equal highs and equal lows. What are they? Equal highs is simply resistance. Equal lows is simply support. This is how retail traders see it. Now, at resistance, we know retail traders are selling, and at support, we know retail traders are buying. So above these highs or below these lows, there is a lot of built up liquidity. These are the most frequent and also the easiest to understand types of liquidity. This is why I say you should prioritize them in today's lesson. Now, how can we use these when we are trading? Now, if we found a buy opportunity right here, say we found a fair value gap right here, we could place a long position and we could place our take profit at these equal highs. Why is this? Because we know there is liquidity right here. We know there's a liquidity pool which market is attracted to, which market is going to come take before reversing. So this would be our ideal take profit. Same with equal lows. If we found a selling opportunity, so if we found an order block right here, market comes, taps into our order block, we place our take profit at the equal lows right here, and we sell all the way to the equal lows because we know there is a liquidity pool right here which market is going to take or market is attracted to. Now let's consider using equal highs and equal lows when framing a trade. Now, I told you guys how we can use it for our take profits if we are buying up to these equal highs or if we are selling down to these equal lows. What if we wanted to trade off equal highs? What if we wanted to wait for market to come, take out this liquidity pool, then sell off? Liquidity sweeps are really the most optimal place to place a trade. This is because you'll get the most impulsive move. You'll get the biggest move and the move with the most volume. As I said earlier, there is many retail traders selling right here as resistance. What we're not going to do is join them. This is because sure, it might work once right here where we have this resistance holding. We might even have it hold again. However, for the third time, if you want to then place a sell here, market is simply going to take you out and you're going to be used as liquidity. There may also be breakout traders. So once market comes up here, they're going to start buying right here. They're going to hope market is going to move upwards. Now, once they are buying here, they're going to place their stop loss somewhere down here. So when market reverses, hits their take profit, this is more liquidity for the market. All market is doing is reacting to the orders. Now, if there are plenty and plenty of orders up here, so once market hits this area and we take out all this liquidity, as I said earlier, guys, if resistant traders are selling here and they have their stop loss here, once their stop loss gets hit, this is where the term stop hunts come from because market is hunting their stop losses. So once market does eventually hit their stop loss, if they have a sell position, they have to buy back their position at a worse rate. The key premise of this is that you are a trader. If retail traders are selling here, that means once they close their position, they have to buy it back. This is also where the term buy side liquidity comes from. This is why if we have equal highs, sometimes this is referred to as buy side liquidity and equal lows will be referred to as sell side liquidity. This is because we have a lot of buy side liquidity here which market can come take and use this liquidity in order to place a sell position. So now we know we can use equal highs and equal lows to firstly frame our take profits, secondly to avoid silly losses. So we will not be trading support or resistance as we will be used as liquidity. We're going to wait for the sweep of liquidity. Wait for all those traders who are losing out on their positions for us to then take our winning position. With all that said, I'm going to hop onto EURUSD and show you guys an example of equal high and equal low liquidity. So let's get into it. Now, when you look at this chart, what do you see? Firstly, I see this level of support right here. This just shows me there is liquidity right here. So I'm going to mark that out. I know there is liquidity right here because retail traders that are buying this area have placed their stop losses right here. So this is what institutional markets are going to come and try to take out in order to fund their position. So firstly, I know there is liquidity below these equal lows. Where else is there liquidity? Right here. You guys can see we get 1, 2, 3, 4, 5, 6 touches with 1, 2, 3, 4. We get 4 relative touches as well. Now, it's not perfect as you guys can see. However, the point still stands. Everyone who is selling right here is placing their stop loss above this high right here. So we all know all the orders are up here, all the stop losses are up here. So we know there is more liquidity up here. So I'm going to play out market and see what market does. Now, as you guys can see, we take out this area of liquidity very, very easily. Now, what is the next probable cause for market to do? What will market do next? If you guys look up here, you guys can see there is equal highs. Now, I know it's not clear on the 1 hour time frame. We have 1 wick, 2 wick. If I hop down to the lower time frames, you guys will be able to see it is equal highs. So we have equal highs all the way up here, and we know any retail traders that are selling these equal highs will place their stop loss above this area here. So we know market will probably come take out these equal highs before reversing. What market loves to do is come take out one side of liquidity before reversing and taking out the other side of liquidity. So how can we use this to our advantage? We can frame an entry off this concept. What I'm going to wait for market to do is come out, take out these equal highs right here. So let me just play out market a little bit more. And you can see we eventually do take out these equal highs right here. So I'm going to rewind market a little bit. And lo and behold, what can you guys see? We get a breaker block plus a fair value gap. So we have a breaker block right here. And if I just play out the next candle, you guys can see we get a fair value gap right here. We get this displacement candle and we get this market structure shift to the downside. Now, this isn't the only area you could have entered from. If you were down here in the market, if you had a chance to enter from here, if you caught this fair value gap, for example, I'm just doing this off the top of my head, and you placed a buy order right here, for example, stop loss below this candle's low right here, and you targeted these equal highs right here, this would be a perfectly valid trade. This would be an amazing trade, in fact. You hitting 40 pips, because as I said earlier, guys, you can use liquidity. You can use equal highs and equal lows in order to place your take profit. We know market is attracted to these areas. We know there's liquidity here. We know market wants to come, reach these areas so they can reverse, so they can get that liquidity in order to place their positions, in order to fund their positions. So this is a perfectly valid target for us to use for our take profits. Now, for those of you who wanted to trade the sweep here, the reversal here, as we know, we trade over these old highs. Now, you guys are about to see how energetic the move we get will be. Now, if I just play out market, firstly, I'm going to place my position right here at this breaker block right here. Stop loss above the high. And now, for your take profit, as I said earlier, guys, you could target these lows right here. You could target this area of liquidity right here. You could even target this area of liquidity. Or you could go target this area of liquidity or even this area of liquidity all the way down here. Now, if I do end up playing market, you see we do get entered in, and you guys can see how energetic the move really is. This is all because of institutional buying and selling. As you guys can see, once we came up above this level of liquidity, market had enough. Institutional markets had enough to place their position. These big candles, these cannot happen by themselves. They need a lot of institutional movement for it to happen. All market done was come above this high, take this liquidity before quickly reversing. Now, you guys can see we do hit full take profit, which was about 130 pips, which is absolutely amazing. As you guys can see, we do smash through this area of liquidity, this area of liquidity, and this area of liquidity. As I said earlier, guys, what market loves to do, market will come, we'll take one side of liquidity, market will come, we'll take the other side of liquidity. Now, this is what you can use to enter on trades. You could either trade up to the liquidity, or you can trade against the liquidity as we have in this example. All we are doing is understanding liquidity so we end up on the right side. We don't end up getting taken out here before market quickly reverses. We want to enter off market taking the liquidity so we can catch huge moves like this right here. Now, let's move on to trendline liquidity. Now, all we're doing when we're looking for liquidity is looking for areas in the market where there are a lot of orders. Now, what are trend lines? Trend lines are a retail pattern that retail traders use where their expectation is that market is going to come, we're going to reverse, and we're going to tap onto our trend line, sell off, come back to our trend line, we're going to sell off. The point being, market comes to our trend line and we move away from our trend line. We come back to our trend line and we move away. So the expectation from here would be market would come, touch our trend line, and sell off. So if I end up playing market for you, you can see this is exactly what market does right here. So get a touch right here perfectly. So we would consider this a pretty strong trend line as we have 1, 2, 3, 4 touches. So this is a pretty strong trend line that a lot of retail traders will be trying to get in on. So what types of liquidity do we have in this trend line? Firstly, we have retail traders who are trading when market comes and we tap our trend line. This is one type of liquidity we have right here. They'll be placing their stop somewhere here, maybe targeting lows as so. So another way retail traders like to use trend lines is on a breakout. Say we break out of this trend line right here. What they'll look for market to do is come, retest back onto our trend line before selling off. They'll have buy stop orders right here. So they are going to be buying right here, as you guys can see. So all they want to do is catch the continuation. So when market continues upwards, that's what they want to catch. Now, if we have two types of liquidity as shown right here, what market will normally do, we will come, We will take out firstly these traders who are selling at the trend line here. We'll take out their stop loss before. Now we have these buyout traders who are entered into the market. Now they have their position triggered. Now market is going to come back down, take out their stop loss before reversing. I'm going to play out the market and show you guys how this works out. Now, before I play out market, I'm going to show you guys how you could have caught a trade using trendline liquidity. Now, for us traders, trendline liquidity can be used for us to be able to catch a trade, and I'm going to show you guys how. Now, if you guys use our example of equal highs or relative highs in general, we could be targeting this high, for example. Now, if you were looking to go long on EURUSD at this specific time, you could have used this trendline liquidity as a confluence. As you know, market would come and take out this liquidity right here. What could you have done? You could have bought right here on this order block, for example. So now you could target right here. Now retail traders believe market's going to come, touch this trend line and then sell off. They also believe if we do have a breakout, that's our change in market structure. However, we as traders know only times market changes in structure when we come over these highs right here. So I'm going to play out market and see how it goes. So we do very, very quickly hit full take profit. And as you guys can see, we do get that full market structure shift to the upside. And you guys can see how much volume market really moved with. In one candle, we was able to cover 50 pips. This is all because of the trendline liquidity, which market absorbed. And you guys can clearly see what I was demonstrating. Market has come. We've firstly taken out people who are selling at the trend line. Then we've come back to stop out any breakout traders. It is as simple as that. Now, here is another scenario of how you could use trend lines to frame your bias or to end up in a trade. So as you guys can see, we do have a PD array here and we do have trendline liquidity against it. When we have liquidity against the PD array, this is called inducement. So this is our induced level of supply right here. So what I'm going to expect market to do is come take out this liquidity, tap into our PD array, which is our order block for this instance, and sell off. So if I play out market, you guys can see, let me just drop down to the 15 minute to make it clearer for you guys. You can see, firstly, we do take out anyone selling on this trend line right here. We come down. So market firstly comes above this high, which is likely where all the stop losses are, and maybe buy stops, where breakout traders are placing their buy stops here to try to catch the continuation right here. So as soon as we sweep this high, market reverses, quickly stopping out any breakout traders right here. So we get liquidity in two forms, and we do tap into this PD array right here if you were to sell on this order block. Now from here, simply stop loss above the high and take profit at these equal lows right here. So we're using two concepts in one. We're using trendline liquidity and we're using equal low liquidity. Now if I play out the market, you can see we do get a perfect exit and a great entry. And you guys can see in every single trade how much momentum market is really moving with. This is because once market sweeps liquidity, market has enough to get those impulsive movements to the upside or to the downside. Now our third and final type of liquidity is range liquidity. Now I have a whole video covering external highs, external lows, internal and external liquidity on my channel. Make sure you guys check it out. It will help you a lot. Now in this video, we are only going to be focusing on the external range liquidity. Now if you are familiar with external range liquidity and internal range liquidity, we know market always does one of two things. Market will come, sweep a high or a low, then come fill internal liquidity, which is fill a fair value gap, then move back to external range liquidity. So what does this mean? This means, for example, market will come, sweep this high before returning to a fair value gap, before coming back to external liquidity. So we come, we sweep a high, which is our external range liquidity, or we could sweep a low. From there, market will return, we will fill a fair value gap, which is internal liquidity as it is on the inside of our range. And we will come back and we will take external liquidity, which is a swing high or low. All it simply is, external range is simply a swing high or swing low. Internal range liquidity is a fair value gap. So all you need to know is market will move from external to internal to external to internal. Now, if you're confused, don't worry. I'll hop onto the markets and show you guys a couple examples. So let's get into it. All right, I am on EURUSD on the 15 minute, and I'm going to be showing you guys how range liquidity works. Now, firstly, we do have equal lows right here. Now, this is our first external range liquidity, sorry. This is our second external range high, external range low. This is our range. So we have equal lows here, which is just more liquidity here. So market is likely to take out these equal lows. That's what I'm going to keep a mental note of. So if I play out market, we're going to wait for either the external range low to be taken out or external range high. And as you guys can see, we do very clearly take out this external range low right here, which also is equal lows. Now, remember what I said, when we take out external range liquidity, market likes to come back and take internal range liquidity, which is a fair value gap. So what fair value gaps do we have? We have this fair value gap, which has sort of been mitigated here. We have this unmitigated fair value gap, and which is also paired with a breaker block right here. So this is the most highest probability fair value gap right here, as it is paired with a breaker block. So we know we've taken this external range low. Now we know we're going to return to internal liquidity. So if I play out market, you guys can see, let me just rewind chart for you guys, that we do tap into this fair value gap right here, plus our breaker block. Now from here, it is as simple as placing your trade and setting your targets. So stop loss above the high as usual. And if you guys do remember from earlier in the video where I told you you'd place your take profit at liquidity levels, so we do have relative equal lows right here. This is where I'm going to place my take profit. You could place it lower. You could place it, say, at this low right here. However, for now, we are going to target these lows. Now, if I play out market, you can see in one candle, we do hit full take profit just like that. Now, if you guys are still not noticing a trend with every single trade I take, it is very, very energetic. As you guys can see, we're hitting take profit in like 15-30 minutes in one candle. Liquidity is what makes price move, as you guys can very, very clearly see. If you guys trade with liquidity, you can get great impulsive moves just like I am. All we did was outline our external range liquidity right here. We have external range low, external range high. Waited for market to take our external range low right here, which it did. Return to our internal range liquidity, which is a fair value gap, and then sell off. Coming back, we're placing our take profit at equal lows or external range, with this being our range right here. So this is our short-term range, which market smashed through. If you are not making at least $10,000 a month from trading, then listen up. Me and my team can pass your FTMO challenge, both stage 1 and stage 2, getting you completely funded as we have for many other clients. Once you are funded, we can use the same system we have used to pass your account to then generate you amazing profits on your live account. Make sure you guys join the group Telegram at Pass My Challenge, the first link in the description, where you guys can see the many testimonials we have. Here is Abdi. Abdi was unable to get funded for a lot of times. He's tried to pass his own prop firm many times. He has failed. However, with us, we passed his prop firm first time, and we also managed to get him $8.5 thousand in payouts, which is absolutely amazing. Here is my FTMO certificate where I've passed my FTMO challenge, and only 20 days later, I was able to get a payout, which is absolutely amazing. I was able to pass my challenge, and in the same month, I was able to receive a payout of $5,000. Now, we are changing so many people's lives. If you guys go join the group, you can see screenshots of how well our system really performs. So if you guys do want to get involved, intake for this month is limited. So make sure you guys join the group and DM me at Ems Capitals for more information. Now, I just want you guys to hop onto the market by yourselves and back test this and see how it works. As you guys can see, we take out this external range low right here. Market reverses, we can't fill a couple fair value gaps such as this fair value gap right here. Now we can see market is not reacting off this fair value gap, therefore we know our confidence is built up to this external range high, with this being our new range. So once we take out this range, you know this is our new range. Now we do fill this fair value gap right here. Now I can see market does seem like it's respecting it. If I play out a couple candles, you see we get a good rejection of it. This is how I know we are going to take our external range high. Now, there's many ways which you could place a trade off this type of liquidity, which is range liquidity. It is very useful. I want you guys to backtest it for yourselves and see how fantastic it works. Now, thank you guys so much for watching. Today was quite a long video, so I hope you guys can rewatch it again just so you guys can process all the information you need from this video. Make sure you guys join the free Telegram in the description where I post many gems. Thank you guys so much for watching, and I'll see you guys next time.